Hi, Stephanie. Hi, everyone. Thanks for dialing in today. Today is our second live market commentary that we're doing here at StashAway. This is where we talk about the latest developments in the market. This is also where we share our thoughts on them. To start it off first, let me introduce myself. I am Albert. I am the Deputy Country Manager here in StashAway Malaysia, and I will be your host for today's session. And we are joined today by Stephanie, who is the Co-Chief Investment Officer at StashAway. And since this is a live event, if you have any questions regarding what we talk about, or even on StashAway, do feel free to post it in the side chat box, and we will get to you after the end of the session. But yeah, how are you, Stephanie? I think it's been a month since we last spoke. A lot has happened since then.
Yeah, it's been a very, very eventful month for markets. I mean, September tends to be quite notorious for risky assets in general, and I think this year it has been no different. If we look at kind of all the risky asset classes, I see a red across the board. So most risky assets are actually down. Difference is only like down by how much. I think we'll go into a lot more details, but mostly it's because of concerns on the Fed's action. Not just at the latest meeting, but also in the few meetings that we'll face in the next few months.
Yeah, I'd like to zoom in on that point because we have seen a very, very roller coaster, exciting week. Last week itself, we saw stocks they took a big hit. We've seen treasury yields jump, and that was all on the back of stronger than expected economic numbers. So examples like U.S. job employment figures coming in better than expected. We have the services purchasing manager index that came in also above expectations, and also unemployment rate of about 3.5% for the latest month, down from 3.7% in August. So given these stronger than expected economic numbers, which on the longer term basis, they are declining. What are your thoughts on this, and where are we headed?
Yeah, I think the market is very jittery because what Powell and the Fed has told us is that they don't have a crystal ball, and their decision is going to be data dependent. So every piece of incoming data would be scrutinized, and that includes two major areas. Number one is, of course, inflation, which is what caused the current hiking cycle. And there are, of course, like different measures of inflation. We're going to get the CPI tonight. And the second area is, of course, jobs growth, because the other kind of economic metric that the Fed uses to gauge how strong the economy is actually labor market. So that's why, the jobs data was actually a very, very important driver of the Fed's decision, and so market performance as well. And as Albert correctly pointed out, last week we got the latest non-farm payroll numbers, and I think the market was a bit surprised at the unemployment number, which fell actually from 3.7% to 3.5%. And it's not the right direction, because the Fed's tightening was actually targeted at cooling off the jobs market. Their theory is that once the job market cools down, wage inflation would be eased, and if people are not getting paid, or if the wage is not going higher, they wouldn't have extra money to spare on goods and services, and that would actually put some downward pressure on prices. However, the unemployment rate was actually 3.5%, which is very, very close to historical lows. And if you look at kind of a longer term horizon, the unemployment rate on average was around 5 to 6%. So if you think about the Fed's job, if they want to get kind of unemployment rate back to a more historical average number, or even at an area that they're comfortable with, it's still a long ways to go. So I think the market was a bit disappointed at that number, and hence the market sold off. And also, of course, we had a very, very strong start to October. So it's basically market volatility. If you look at kind of a 1 week basis, the market was up very strongly at the beginning of October, gave back all the gains at the end of the week. So again, it's just very, very volatile markets. But talking about jobs data, actually the Fed has told us that they have an alternate, they have a different, metric that they also focus very, very squarely on. and that is the job openings per unemployed person in the US. And Chairman Powell has actually said that it is one very important metric, because the level of job opening to unemployed people basically tells you that, if there's a lot more job opening than unemployed, then companies actually need to pay a lot more to get talent, and that puts upward pressure on wages. And in fact, for that number, it went up as high as 2 times, i.e. for each unemployed person, there's actually 2 job openings that are waiting for them to be filled. And hence, I mean, one of the Fed's target is to actually get this number back down. If you think about kind of a more reasonable number, pre-COVID, that number was around 1.2, 1.3. So for each unemployed person, there was 1.2 to 1.3 job openings. And I think that is actually what the Fed is targeting, to get it back down to pre-COVID levels. And actually on that front, there is some good news, right? In the latest August jobs report, which is a different report, basically job openings fell by 1 million jobs in a month in August. And that was actually one of the biggest month-on-month drop in terms of job openings. The last time we've had that was actually during COVID. So the labor market, by a different measure, is actually cooling down pretty quickly. And given the 1 million drop in job openings, the opening to unemployed ratio actually fell by 20 basis points from 1.9% to 1.7%. So it's still not still not close to 1.2, 1.3 that the Fed would be looking for, but it's making kind of the right direction. But it'll take some time. So I think if the market tends to focus on some headline data, 3.5, but if you look kind of underneath, there are other measures that shows the labor market is indeed cooling. And more importantly, I mean, the Fed also looks at a wider set of data.
Yeah, so I guess there are a lot of noises or signals flying around, and we just have to look into the devil of the details itself. Another, I guess, volatile or interesting event that had happened earlier this week too was where we saw the US itself introducing export controls on China's semiconductor development. So this came in the form of the US Department essentially barring American companies from shipping certain grades of advanced chip equipment to any Chinese companies. And the result of that is that we have seen semiconductor stocks, like TSMC or Samsung itself, fall as a result of that news. In fact, there were new developments today saying that these companies, some of them were granted a 1-year exemption. So given this development and combining with concerns about rising inventories reported by some players in the industry, we've also seen a fall in factory shipments coming out of Korea, which is sometimes seen as a proxy for global semiconductor demand. What are the implications to this to the broader industry as a whole, and also by extension, what does this mean for that rivalry between US and China?
Yeah, I think you brought out 2 very important implications, and they're slightly different. One is more cyclical, the other one is more structural. So let's talk about the cyclical part of that, which is the semiconductor business cycles. Actually, if you think about semiconductors, is basically the oil of the digital era, digital economy. It goes into everything that we use, into our cell phones, cars, computers, etc., etc. So the sector is highly volatile because of 2 things. Number one is tied to the global economy. So if the economy is strong, when companies are spending capex, they will of course buy more computers. If you have, let's say, a very strong labor market, they would buy more cars, and car makers then buy a lot more chips. And that explains why we've seen chip shortages coming out from COVID, because of the very strong economy. The other reason why chip makers or semiconductors as an industry is very cyclical is because there's something called the double booking. So chip makers is actually a very, very long supply chain. And when the economy is going strong, because it takes a few months for you to order the chips or along the supply chain. So when the economy is good, actually the downstream players would double order, like order extra inventory from the upstream players. And if the economy suddenly turns and when demand actually falters, it creates a bigger swing because of the inventory that's accumulated. And I think that's what we're seeing in general, because I mean, globally, economies are slowing. US is, I guess, is widely expected to go into recession in the next few months. There are some areas globally, for example, in Europe or even in China, where the economy has been weak for quite some time. So that affects the whole supply chain. And I think that is kind of a cyclical part of the semiconductor industry. And the semiconductor industry, if you look at kind of a stock performance, which can be proxied by some broader industry indexes, it correlates very, very well with economic like growth indicators, for example, the US ISM. So it bottoms out and it peaks out around the same time when for example, ISM would peak out or bottom out. So we are not seeing a bottoming of the ISM yet. So I mean, that's why the cycle in the near term may still be quite difficult. That is a cyclical part of that. And the more structural part of the semiconductor industry is, of course, related to the bigger rivalry between US and China. And I think, I mean, we've all kind of seen the divergence in policies for both countries. And I think given the importance of the semiconductor industry, basically think about it as like the oils in 1970s or 80s, both countries actually want to gain an advantage in this industry. And China has been trying very hard, doing a lot of investments in their own semiconductor industry, which powers, of course, some of the software, some of the infrastructure that is needed to run a modern economy. So this is just another sign that we're entering a more bipolar world, in which, I mean, the economies may be less kind of interlocked compared to what we have in the past 20, 30 years, in the sense that, I mean, China will try to develop its own system of technologies, and US will try to also excel in its own vertical. And I think it's probably going to kind of slow down innovation on both sides, because if you don't have like a lot of cross, cooperation, the same resources will not be as efficient as if you had, for example, global trade and global idea sharing. But this is kind of the new, new macro environment that we're entering. And if you kind of zoom out into a much longer history, much of the human history is actually in a multipolar sort of world than a unipolar sort of world that we've had in the past 20, 30 years. So I think we're maybe returning to a more normal sense of how the world operates. But I mean, it has implications onto, I guess, how you invest and also the rate of return on various investments, which is a big topic, and we're not going to go into it today. But we can definitely, when there's time, we can dive about deeper.
Yeah, speaking about implications, we have, looking forward, right? We have quite a few big events that's coming up that potentially could impact asset classes in general, or even our portfolios. And what's in fact happening tonight is that the CPI numbers for US itself will be released, and in roughly less than a month's time, we would have the Fed meeting to determine what's the direction of interest rate hikes are going to be. So what are your thoughts on this, Steph? What are the implications? Because markets are expecting at least another 125 basis points of interest rate hikes before the end of the year. So that's pretty significant, considering where we were a couple of years or even months back, where interest rates were really low at near 0%.
Yes, I think if you look at kind of the current cycle, it's been one of the fastest rate hike cycles we've ever witnessed. And also, not to mention that we're actually coming off from a very, very low base. So that explains, I mean, why this year, for example, bonds have been performing very, very badly compared to its own history, and even relative to riskier assets like equity. as Albert, you correctly pointed out, I mean, the market is already expecting 125 basis points of interest rate hikes into year end. And I think the question that the market is really struggling with or kind of asking is, number one, where is the terminal rate, i.e., where would the Fed stop? And if you look at market pricing, the terminal rate, i.e., the highest the Fed will actually hike to, is going to be is expected to be at 4.6% in early 2023, and that is quite in line with the Fed's own projection as well. So 4.6% is a very, very high number, and the way to think about it is that the Fed actually wants to. They've already said that they want to have real interest rates positive across the board. What is real interest rate? Basically, it's your nominal interest rate, i.e., if you take 4.6%, and if inflation is also at 4.6%, then I mean, real interest rate is just one minus the other, which means it's zero. So the market is basically saying by beginning of next year, the Fed will be able to tighten enough such that interest rates actually fall to like 4.6% or below. That's why CPI is so important tonight, because that will actually tell us how, not just where is the direction of CPI, but also how quickly CPI is going to come off. Because I think just given, all the tightening, and if you look at commodity markets, which tends to be a good kind of leading indicator of the CPI, it will come off. The question is how, when, and also how fast. If you look at, we actually did some projection on some of the bigger components of the CPI. For example, rent is a big component. Also, wages are a big component. Some of the leading indicators already says that they have peaked out, but the pace of falling off, or the pace of decreasing, is still quite slow, which suggests that we still have a few months of very, very high inflation. So I guess, the data is what it's going to be. It's very, very hard to make a prediction. I'm not going to pretend that we can predict, but just bear in mind that the data is going to be volatile from a month-on-month basis. For example, the jobs data was actually surprising positively in September, and then it surprised negatively in October. Similarly, CPI may surprise possibly on 1 month and negatively on the next month. So typically what we do is we look at a 3-month moving average. So if the market kind of reacts strongly to one print, it's just the market being very volatile. So number one, don't be shaken out by it. We need 3 months of data to establish a trend. And secondly, if being a long-term investor, you want to kind of make use of some of these market sell-off to DCA or to dollar cost average into risky assets. And those may be good chances.
Yeah, speaking about, the economic numbers and also implications to markets, we also have a question from one of our customers here on this point, sure. Saying that with how the Fed is targeting to bring inflation down to 2%, whether that's a neutral rate or not, we will see. But with their determination to do so, and many CEOs, fund managers are looking at potentially a long recession. Why should I invest now?
Yeah, I think number one is that over the long term, if you look at equities or other risky assets, basically you may be too early. You may be down, let's say 20%. If you didn't catch the exact bottom, you may be down like 20% in a very short period of time, like several months. But if you hold on to the investment long enough, you can always make that back and much more. The problem with kind of staying out of the market or trying to time it is that you never know when it's the bottom. At the bottom is always very, very scary, because you would read news headlines like, oh, things have changed. Things are not going to go back to where it was before. For example, I think the most recent example is COVID. If think back when you were reading about news headlines in March 2020, I bet it's very, very hard to invest because the world is changing, and it'll never be like what it was before COVID. And of course, lo and behold, the Fed actually loosened, and then the stock market came back, and then actually you would have gained much more afterwards than if you had been maybe 20% too early. So that is the risk of, I guess, trying to time the market. Now, of course, all of us are scared about market drawdowns. So one good way is to not to put everything, or not to go all in at one point. So a better way to kind of try to get into market during a bear market is to do dollar cost averaging, meaning that you chunk, let's say, you have $100 spare cash and you want to invest, right? But you don't know when is the market bottom. So maybe chunk it up into several pieces. You can chunk it up into 2, 3, 6, or whatever, however many small amounts you want to. But at least, you kind of you get the investment going. You start the habit of investing, and if the market goes up, you would be quite happy because you would have invested part of your cash. And if the market goes down, then you don't feel too bad as well, because you have spare cash to take advantage of the lower market prices. So I think that is one good way to think about it. At the end of the day, we're trying to, I guess, make investment less stressful. And trading in the short term is very stressful, but investing for the long term shouldn't be that stressful. So using techniques like DCA helps to lessen the stress associated with investing in very, very volatile markets.
Yeah, and we earlier we did touch a little bit on China itself in regards to the export controls imposed by the US, right? I'd like to allude to next week itself, where we're going to see the potential 20th National Congress in China, and this is where it's quite likely going to be Xi Jinping potentially staying on as premier for another 5-year term. And so we also have a couple of questions from customers saying, given, is China really an investable place right now? Because there's been a lot of focus from the top on stability, common prosperity. And I think this is something that they want to ensure leading up to the event next week itself. But on the back of it, you also when you look at property prices, which have plummeted quite a bit in China, there is some degree of instability there. So I'm happy to hear more about your thoughts regarding this topic.
Yeah, I think, typically, China would try to do some window dressing into the party congress. And we actually haven't seen that much going on this year, which is not very typical. But I think for what's on the China leaders' mind is top and foremost stability. Because there, as Albert pointed out, the real estate market is going through a lot of turmoil. We've gone through, the whole kind of common prosperity. There's whole industries, for example, education being, taken out. So there's a lot of kind of, I think, ripple effects from all the cleaning up that the Chinese government was trying to do in the past 2 years or so. And not to mention, of course, the whole impact of COVID. And also, the new policies from the US, for example, and the strong US dollars impact on, on international economy and trade, etc. So there's a lot of different issues that the Chinese government is trying to, grapple with. And I think one of the biggest question that investors care about is actually, will China reopen after the Party Congress? Because there's been a lot of expectations, or the consensus is that China will actually start to reopen its economy, and you're going to see a cyclical upturn pretty quickly. I think the answer to that may be a bit more nuanced. I do see that China is taking some steps to try to open the economy, but I'm sitting in Hong Kong, and it's taken Hong Kong a long time to reopen. So I think that from the China leaders' mind, they will be quite careful about reopening the economy, but I guess, China being slow in opening the economy may be a blessing in disguise for oil prices or for inflation, for example, because if China reopens tomorrow, oil prices would actually shoot up another $20. So that may not be a completely bad thing in itself. I think you have to, as investors, we have to bear in mind some of the kind of constraints that sometimes these leaders and political leaders actually face.
Well, Leon here has a question which is essentially very direct. So he asks, should we invest in China? So given what we just talked about, what do you think? Is it yes, no, maybe? Should we wait until there's clearer data coming out of next week?
So if you look at taking a look at data, typically, China equities, I assume we talk about equities. If we talk about FX or bonds, right, we can answer that as well. But Chinese equities tend to perform better if if you look at China PMI, if China PMI is above 50 and trending higher. So we're still, not very affirmative on China's economic recovery. And I think we need to see some more signs that the economic recovery is stronger and it's taking place before Chinese equities would start to outperform the world. And also remember, Chinese equities tends to be a bit more cyclical or a bit more volatile than, for example, the US. So especially when the currency is weakening, if you buy into China equities, you would also take on FX risk as well. So right now, the US dollar is still trending very, very strongly. And I think it's very hard for the renminbi to appreciate unless all the different trading partners, including Europe, Japan, currencies actually start to appreciate. So we're monitoring it very, very closely. And the data doesn't suggest that it's a good time to go into China. But when it says so, we'll be ready to invest in China again.
Yeah, pivoting a little bit to bonds itself, because there are a couple of questions here from our listeners. We have seen this year that bonds have probably had their worst year in a very long time. And if you look at the Bloomberg Aggregate Bond Index, it's down roughly around 15%. And a drop of 15% is pretty big. And so we got a question here from one of the listeners asking that, okay, given a rising interest rate environment, why is my bond portfolio dropping, and should I continue investing into it?
Yeah, bonds are let's do a bit of bond 101, right? So bonds are basically if you issue bonds, you're borrowing money, and if you buy bonds, you're lending money to somebody else, right? So every bond has a maturity date, and let's say if I borrow money if I lend money to you for 10 years, it's a very, very long time, right? So in 10 years' time, you're going to get your principal back, but also your coupon back. The value of this bond is actually discounted by the interest rate because, I don't get my money back until 10 years later. If inflation is very high in 10 years' time, that money will not be worth that much. That's why the longer the so-called duration, the longer the maturity of the bond, the more is affected by interest rates. So when interest rates actually rise, the bond value, because of the discount, actually comes down. And this is what we've seen this year. And I said, when I was talking about the Fed's action, I said, number one, basically, this is one of the fastest rate hike cycles we've ever seen. And then secondly, because we're starting from a very, very low interest rate environment, the increase in interest rates actually have a much bigger impact on prices. So when we started the rate hike cycle, it was almost starting from zero. And if you think about the bond returns, it has two components. The number one is, of course, the coupons. So if a bond is paying, let's say, 4% interest rate, which is what the U.S. Treasury is paying now, at least I would get that 4% every year. So if it doesn't matter if the bond price fluctuate, I get that 4%. But if bond prices come down, let's say by 2%, my total return will be 4% minus the 2%. I still get 2%. However, at the start of the year, because interest rates were almost 0%, you don't get that buffer. And let's say the coupon was just 1%, but actually because of bond prices movement, the bond price return was negative 3%. You still lose 2%, and that explains why. This year bond returns have been so bad. But if you fast forward to today, I think about the terminal rate that I talked about. Right, the market is expecting 4.6% terminal interest rate, the highest interest rate in this cycle. We're already for 2 years, we're already at 4%. So we've gone through a lot, right? We've gone through maybe 3/4 or I don't know 2/3 of that rate hike cycle, or even more, maybe like 80% of that rate hike cycle. So there may be still a bit of pain, but at least you're starting from like a 4% environment, which gives you some buffer already. So I think that's how I would think about like investing in bonds right now, because what happened in the last 12 months was a combination of very fast interest rate hike and very, very low starting interest rate.
Right, there you have it, in terms of a one-on-one class on bonds from Stephanie itself. Unfortunately, we are out of time, and we do have a couple more questions. So if you are curious to learn more, understand more our views, please do write in to us at support@StashAway, and we'll be happy to address those questions from you. But that's it for tonight itself. We will be doing this live commentary every month, so do stay tuned, and we will see you back again. Thank you very much, Steph, and take care, everybody.
Thank you, Albert, and thank you, everyone, for sparing your time tonight.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store, so you can start on your financial journey right now.